Welcome, everyone. My name is Mark Caesar, and welcome to the Financial Freedom Through Apartment Investing, a proud affiliate of the GOB network of apartment investors. And today I have a special host, a guy that I hold with high esteem, Jim Biggs, who will be hosting with me as well. And we have a very special guest in the house tonight who will be speaking on asset management. Jim, did you have anything you wanted to chime in?
Yeah, my apologies right off the bat. Turn off all your cell phones and listening devices. So yeah, I would like to introduce our special guest tonight. Ms. Kimra H has been in the industry for 40 years and has been a premier asset manager for some of the largest REITs and institutional buyers in the country. And she is going to share some ideas and have a discussion with us tonight about one of the most guarded subject matters that is very, very difficult to find information on. Very easy to get, some high level comments on it, but we're going to try to dig a little deeper tonight and pick the brains of somebody who's, needless to say, one of the premier experts in the industry. So having said that, also would like for Kimra to have an opportunity to expand on her background a little bit if she would like, and also to mention that she has not only been an asset manager for these large players in the industry, but also has backed that up by helping them to start their own property management companies and build out vertically their business model. And so she has built from the ground up many times over property management companies and has recently launched her own property management company, taking all of that experience and rolling it up into one and offering it to the people that are lucky enough to get to work with her. And Kimra, I'll let you say a couple of words.
Come off mute, Kimra.
There we go. Now I'm off mute again. Got it. Think quick on my feet. Thanks, Jim, for the kind words. As Jim mentioned, I've been in property management and asset management in the multifamily arena for 40 years. And I've had just lived a charmed life within the industry, being able to work with two of the largest REITs, growing from 30 properties to over 1,100 in each of two companies. That's a lot of due diligence, that's a lot of transitions, and that's a lot of deals. In then leaving in 2008 from the public world, I built a property management platform and asset management platform with a partner for a syndication group out of the state of Washington. And over 12 years, we went full cycle on 56 multifamily deals, 58 senior living deals, and a handful of commercial and other types of properties. As Jim said, we closed that one down in July. On Friday, opened this Vacinia Living on Monday, July 18th, I think it was. And today, in 7 months, we have 32 properties under management with 18 more coming on in the next 60 days. So we know how to help on the deal side. I've also been an investor. Along with being an asset manager, I do understand the challenges, and I'm here to share all the nitty gritty with you tonight.
So thank you so much, Kimra. I forgot to mention that you are also an investor, and you've done this on both sides of the equation, if you will, and that also even though we're going to concentrate tonight on apartments, and specifically the vast majority of us are dealing with C-class and B-class apartments, that you have managed across all asset classes, that you've also managed things outside of multifamily. You've dealt with low income. You've dealt with A-class. I know you've done some commercial work on commercial asset management. And so I think that the expertise and the creativity that you can bring across all platforms, is unique. And we really are looking forward to sharing some of that with you tonight. And with that said, I would like to kick it off and just jump right into the deep end of the pool and ask you if you could share with us what asset management is and how it differs potentially from property management. And we'll start digging in a little bit into what everyone thinks asset management is and what we think we can do as asset managers versus maybe some of the reality.
Sure, thanks, Jim. So what is asset management and what's the purpose of it? Well, the aim of a commercial asset manager is to extract the maximum revenues from existing and future assets while taking into account the risk profile of each owner or ownership group. Now, to unpack that, that means that you need to be focused on key indicators that are going to drive that business. And that is different than your property managers really looking at the details of the performance of the property. As an asset manager, you need to always be measuring the market, knowing what's happening in the market, and being ready to position the property or portfolio that you're overseeing into its next phase, whether that be an exit strategy, a refinance, a supplemental, whatever it's going to take that property to deliver the highest returns possible.
So if I'm hearing you correctly, you're saying that the asset manager's job is on a high level view to really be concentrating on that NOI, really be concentrating on trying to not only drive that, but also look at any other possibilities in the marketplace, constantly comparing to not only the marketplace, but your competitors. And looking at the big picture. Do we have enough equity? Could we pull equity out? How do we pull equity out? Are there additional partners we could bring in and return money to investors? And a lot of these higher level pieces. Whereas the property manager, I'm assuming here that you're depending on them to carry out this big vision for you.
You said it perfectly, Jim.
Oh, fantastic! So that's amazing that a hillbilly. Not only did I not have to pronounce any 3-syllable words, but I got one of the good ones right off the bat. So, talking about KPIs, Kimra, can you share with us maybe the top 5 KPIs, or ever how many you want to share that we should be measuring as asset managers?
Yeah, I actually have 8 as an asset manager. What I feel are really important for you to always have a finger on the pulse and be aware of. The first is cap rates, understanding your market and what's happening in the market surrounding your property, where where similar deals are trading at, what's going on with the cap rate, because that helps you measure how you're doing towards your exit strategy, where you are in the midstream. You might find that, it might have been a planned 5 or 7 year hold that you found yourself in a real bit fast uptick market that, you know what, the exit comes in 2 years, but that allows everybody to recapitalize their money into new deals. But you really got to be paying attention to cap rates. And that's one that really demonstrates, what's going on in your market. 2, the IRR is important in a deal. You should know what your goal is, how to calculate it, what it looks like going in. Three, when we talk about the financial metrics of a property, there's two components. One is what I refer to as EGI, effective gross income. That's all of your total revenue, your gross market rents, your gain loss to lease out of there, your vacancy removed, concessions removed, all of your other income added, all of your utilities or RUBs added in, and that gives you your gross income. And we refer to that as EGI. Having an understanding of how that ebbs and flows and what drives those big movements up, and understanding why it's moving up when it is moving up, or goodness knows when it does cycle downward, why is it cycling down? Do I know what's happening in the market? Am I connected with what's in the market? Okay, that's EGI on the revenue side. For the NOI, net operating income, that's taking your EGI and subtracting out all of your operating expenses. That's above NOI, and that gets you your NOI. That number is a real important number because it's used to calculate many pieces of the valuation of your property. 5, the cash on cash return. You know, how is the property performing to what you had planned your cash on cash to be? What does that look like? Are you actually distributing what you had initially set out to? If not, why is that? Does it make sense why it's not? And can you eloquently and succinctly explain to your investors why that's not the case? And what's the plan to get back on track if you do fall off track? 6, the DSCR. This one, the debt service coverage ratio, is critical. This can yank the rug right out from underneath you if you have loan covenants excuse me, within your loans that say you have to be at a certain level. If you're not, the rug can be yanked right out from underneath you, and then you're left standing there going, what should I be doing now? But measuring that, understanding how the lender measures it, because every lender has their own calculation in what they add and subtract to your NOI. Just because your financial statement that you receive from your property manager says my NOI is $100,000, if you go to your loan docs and understand what those loan docs say, it may be that they're discounting many things that you have put below the line, like you consider mini blinds, let's say as an example. You put those below the line as a capital expense. Well, guess what? They're going to take those and put them up in operating. They're going to rearrange your financials and then say, this is what you're being measured on. Okay, so you need to understand every single deal you have and what that debt service coverage ratio means to that lender, because it can vary widely. All right. One other little side note on DSCR that can many times be negotiated is the timing period of when the DSCR is measured. Is it quarterly? Is it annually? You can imagine if it's annually is probably the most preferred. These days and times, it's hard to get that, I'll tell you, but having only one measurement, one hurdle to hit with that DSCR measurement is ideal each year. But many times you're looking at it over a quarterly basis. Well, guess what? Your first month, if your first month's May and your last month of that period is July, that's one of the biggest, those are your big turn months, turnover and costs of renovation or repairs. That hits your bottom line pretty hard, and that can really throw off your DSCR. So as an asset manager, you need to understand what your projected expenses are going to be and be measuring to that on a regular basis. Because if you're missing it in a month, you need to figure out how you're going to get back on track, or that rug is going to be yanked out from underneath you. 2 more, Jim, just 2 more. The number 7 is cash flow management. This is very important, okay? Because yes, the rents come in And in most part, they pay the bills pretty well, right? That's what the plan says. That's what your underwriting says. Well, what happens when there's a delay in a capital draw that you have done with the lender to pay vendors on your aggressive business plan to do all this interior work, while your vendor's saying, I need paid, it's been 30 days, but the lender, well, maybe as an asset manager, I just didn't get around to, approving off on that reserve request for 2 weeks. Then the lender gets it and waits 2 weeks. And then the lender wants to do an inspection before they release money. Perhaps not always, but sometimes, you never know. So if you're not managing your cash flow, your vendors could be walking off the job and pausing everything on your business plan. And in today's times, with the difficulty with construction materials, that can really set you back. Because once that plan gets moving, you want to keep it moving. So cash flow management, understanding it. If you manage your financials, or your property manager does, to a cash basis, not accrual basis, you need to understand those two differences and how that can impact. Now, tonight's not an accounting class, but there are positives, pros and cons to both. But with cash accounting, you don't see everything clearly. You only see the cash coming in, and the cash going out. Well, with that approach, you can be surprised with a really big expense next month that you should have known was coming in, but you don't have that visibility in the cash piece. So understanding where your cash is and the projected forecast of where that's going to be is going to help set you up for great success. And then the last, number 8 KPI, is investment performance analytics. What does that mean? It's kind of all the things I just talked about, only for your investors and your JV partners, or your other GPs, whoever those are. You need to have a defined process targeted for each of those groups. What moves the dial for them? With some really complicated ownership structures, with waterfalls and all kinds of things, there's all sorts of different measurements you need to know. There's all kinds of platforms out there that you can use as resources to help you watch this, but someone needs to be looking at it and analyzing it. The software doesn't just do that for you. It gives you a pretty dashboard. It gives you all the information, but you have to have your eyes wide open and reviewing it. Someone on your team needs to be reviewing it always and constantly. 8 of them, Jim.
That is a lot to digest, Kimra. That is a lot. So let's dig into a little bit of those. And I'm really glad that you brought up the cash method versus the accrual method. And I know you said it's not an accounting class tonight, but that relates back to some other things that we see a lot. And before it slips my mind, I wanted to ask you, how can that impact the T12 in a negative way? So let's say that we're ready to sell an asset, and we're going to pretend for a second that we are not very nice people, and we're going to pretend that we're trying to get the rosiest picture we can possibly paint about this asset. We're coming out of a COVID environment. We're coming out of some really challenging cash flow situations. So what are some things that might not show up for potential buyers on a T12, and how might we be able to mitigate that or be on the lookout for it?
Yeah, that's a great question, but Jim, I can't be a bad person. I got to flip it around, because I've been in this seat reviewing the due diligence side of people who aren't such nice people, who are a little sketchy on that side. And so I'll flip it around a little bit. And just this year, or within the past year, this is a true story. This actually happened. Seller provided their T12. Okay, here's my T12. My due diligence team said, hey guys, we need to see the bank statements. We want to see a check register. And then we also want to see the canceled checks. Okay, because it just wasn't adding up. This was a significantly distressed asset. We knew just from the market and the resident base that delinquency had to be through the roof. We just knew it, just because we've done this so much in that area. And but their T12 showed, oh, you know, their revenues are going along and they're real steady. Well, the buyer of the property, who was our client at the time, chose not to force the issue with the seller. It was a bit contentious. It might fall out of contract. You know, he might just yank it. It was just, the behavior was a little like scratch your head, like, why are they behaving that way? Well, when it all came said and done, the buyers decided to, hey, that's okay. We'll just move forward. We know there's going to be a little bit of delinquency, you know, Kimra and Kevin, we know that's going to happen. Okay, well, what was going on after the deal closed? We were able to point, you know, the very first month we're down in revenue just from close to day month one, we were down in revenues $25,000. Okay, wait a minute, we didn't do anything different. All we did was bring it over. Well, what had actually been occurring all during COVID was the seller, before he sold the property, with the plan to sell the property, had been putting $25,000 of his own cash in each month, like it looked like revenue. Okay, couldn't see it without looking at bank statements and that type of thing. And he was on a cash basis, so it looked like it was all posted to the rent line, you know. It looked like those were his collections. And I can't tell you how many times Kevin, my CFO, who does that part of the review and due diligence, kept saying to the buyers, this could potentially be big. Well, take that amount, multiply it by 12 months. Okay, that was a huge hit to their right out of the gate. Boom. So that's one thing that can happen and has happened, I've seen recently, Jim.
So is there any way for a buyer or someone who's underwriting a deal to be able to recognize ahead of time, or any best practices that they ought to just stand firm and say, look, I'm not going beyond this point. You either have to provide me X, or you have to be willing to let the deal fall apart?
Yeah, you know, in the last, 12, 13 years, every deal we did, we got bank statements. We got check registers. We got all of that. Once in a while, we'd have somebody push back, but we'd always say, then the deal's off, because that could be something that's a requirement. If you have an institutional partner in the group, which most of us don't today, but if you do, it's demanded. So my advice is, during the purchase sale, the PSA negotiation, is to ask for those things. Make sure they're on your list. They might get crossed off, and then it might be a business decision to not require it. You might have to make that in the moment, but at least ask. At least start out asking for those key things, and a delinquency, an actual delinquency report. Something out of some of these B and C properties are C and D properties that we're looking at today. I mean, that we get an Excel sheet that's hand typed. We don't even know if it's real numbers, So a lease file audit can help you tick and tie it out as well. So make certain that you're doing an exhaustive lease file audit. That will help, figure it out.
We've seen in a lot of situations where you take over a property and you got a lot of pushback from the seller. about the lease audits or about releasing a full lease file. So what does, old school to me, being 63, a full lease file is a big, thick manila folder. So what does a full lease file really look like in today's day and age? What should be in it? What is there that we have to look at?
Well, I mean, our lease alone with our addendums is 55 pages. Okay. We just closed a deal, took over March 31st or April 1st, actually. And the manager who was exiting, she had been there with the owner since they built it. And she was like, and when she was signing her lease, because she was going to move in and stay there, she was like, oh my gosh, is this lease like all of them? Oh, this is like, oh my gosh, how do I even read this? It's like, okay, we're going to help you read it, but it's electronic. Okay. So you have all your lease documents, you have applications, you have all the addendums that go along with that, the screening background. But some of these C and D, B, C, D assets, that distressed assets you're buying may have traded 2 or 3 times recently, over the past handful of years. And if they have, most of that stuff gets lost because it's paper. Nowadays, using electronic versions of things, that information's there. But remember, the application for someone who moved in 2 years ago, Jim, may not be legit now anyway because of COVID. So many people had to change careers and jobs. So it's really a revetting and a decision about how you want to move forward when you're looking at the whole picture once you get through your due diligence.
Would you typically expect to see like payment history, the credit and background checks in the file?
Well, in the electronic file, but I will say, because we're electronic, I do everything encrypted. So, we use a company that encrypts everything. So your social security numbers aren't visible. No one sees anyone's social security number the way we do business. But I just recently did a due diligence on an exit on a sale, and they were asking for that. And I said, no, we don't have, there is a key to the encryption, but we don't provide that. We don't even let our site teams ask for a social security number anymore, but the screening results are all available in a report, and we can give you everything that's been reported. And that absolutely sufficed for them.
Fantastic. So, and one more time about the cash accrual versus the accrual method. Is there anything to that that kind of tells you that they're using one or the other when you're looking at the OMT12 and rent roll? And are there any special precautions that we need to take one versus the other?
Yeah. So with cash basis, you're usually just going to see rent and a line of rent across, and then it drops down to your other income. You don't see vacancy, you don't see gain and loss to lease, you don't necessarily see concessions. You might see concessions, sometimes they'll put those in, but usually it's just rent. And the rents go up, and the mainline rent goes up and down because it's based on how they collect the rent. The thing is, if you're seeing rents at 100,000 today on a T12 for the month of March, let's say, 50,000 of that could have been for people who owed you in September last year. You might really only be 50% collected for March. You don't know. With accrual-based accounting, and that's how we operate on the property management side. It's to GAAP standard, generally acceptable accounting principles. You recognize the revenue and the expense in the month that it occurs. So it is more tedious to be able to do that. That allows you to provide a true picture, a more clearer picture, not true. They're both true. It's just different ways to report it. It allows you to provide a clearer picture of how the revenues are being booked and how the expenses should be going out. Even though like an example, we have a deal that we just did due diligence on, and their expenses, I knew they were really low when I looked at the T12 because I've got 40 years experience in some benchmarking. And they were like, oh no, that's everything, that's everything. Well, you know, as we got into it, finally we got an aged payables from them. Yeah, $675,000 in unpaid expenses. Okay, on not a very big property. That's $675,000 of unpaid invoices wasn't sitting in the T12 because it was cash basis and they hadn't paid out the cash to pay the expenses. So you just really have to look at what you're seeing and say, does this make sense? If it's too good to be true, it might be too good to be true.
So I loved what you were saying earlier about DSCR because we have a tendency to look at it in black and white. And most of our models are not modeling DSCR on a quarterly or biannually or let alone monthly basis. And the lenders, particularly as things start to tighten up, start looking at all of these things a lot closer, and they have their own asset managers. And this is one of their key KPIs that they're tracking all the time. And so one of the things that you mentioned, number 7, cash flow management, would have a integral, be integrally tied to measuring that DSCR and knowing whether or not just what your scope of work is and how you had that laid out month to month, but how does that affect that DSCR, how these other pieces interplay with each other, becomes something that we might not be looking at. We might be just looking at the big picture. And that would be what I guess you would, if one of my follow-up questions was going to be, one of the critical mistakes you see us make as mom and pop asset managers, if you will. In other words, you know, it's not our profession per se. We haven't been managing apartment buildings all of our life as asset managers. This is a career that we have chosen and a path that we're choosing to follow. Maybe it's our first, second, third deal. So would that be one of the key mistakes that you would see us making as asset managers, not balancing those different pieces, if you will?
Oh, sure. Yeah, yes, I've lived it. The DSCR. So most of the modeling I've done in the past, we looked at DSCR in the modeling monthly. Okay. But still, it's only as good as the numbers you put in. So mostly you're not massaging for seasonality with your expenses. You're pretty much straight lining it for the year, right? So once you move beyond LOI and into PSA, the underwriting doesn't stop. That's when you get more details and everything that's coming back over from the group that's doing due diligence. And by the way, due diligence isn't just inspecting apartments, okay? It's a whole host of other pieces, or should be. And when all that information is coming back, and you get your budget from your property manager, and you should be layering in, how does this compare? What does this do to my model? Is there any adjustments I need to be making? What's this big hit in July that my property manager has here? That's gonna kill my DSCR. That could potentially, cause a trip of a loan covenant. I know at that point you might not have your loan written out. Jim, one of the things that always just was a pet peeve of mine, I can't count how many asset managers never read the loan docs. Okay. I mean, I would just be, here I am sitting in a meeting, they have no idea what's in the loan docs. I mean, it's a bit intimidating. If you've done a deal, you know how thick they are. And you're counting on your attorney, but But hey, listen, there's lots of business decisions that are being made in there, including your DSCR and how that's measured. Making certain you understand it clearly before you sign those. Okay. But you're, as an asset manager, you're expected to read it from word one through word end. And you need to know what's in it and what it means to you. And I went off on a little side tangent there, Jim. Sorry.
No, I'm glad you did, because that's very important part of your job. You know, your asset management job per se doesn't start after you've gotten the keys necessarily, but well before that. And that DSCR might have a triggering effect on a loan covenant that you might not even be aware of. It might be something that puts you in a lockbox situation.
Yeah,
And now
those are
your
no
hands
fun
are
either.
tied.
And those are no fun. Those are
Yeah.
no fun, those lock boxes.
Yeah.
And many loans today, I mean, more than half I've seen come across are requiring lock boxes. And or maybe it's not a springing one, but and a lockbox means all of the money from operation goes into the lender, and it sits there until whatever's in that loan document says they'll release it. You know, some just hold it till they get their mortgage payment and then they release it. Some shut the box as soon as the 15th rolls around, and you can't use any of your cash for the whole last half of the month. You need, as an asset manager, you need to understand how that's going to work before you sign that loan document, because you may need to go back into your underwriting and layer in higher operating cash reserves, because that could impact you tremendously.
Yeah, and that's one that if anyone on the call just got lost, I think that is why Kimra is saying you need to read your loan documents.
Oh, okay. Yeah. Yeah.
So,
hey, Jim, real quick, one little story. I was on a property that had that happen. We were managing and asset managing it. What we had was a catastrophic fire. Okay, no issue. I mean, it wasn't caused by us. It was arson, but it burnt 4 buildings down. Didn't kill anyone, thank God. But guess what happens when a fire that big happens? You don't have the revenues coming in, but you still got expenses because your residents have to be housed. It's just all kinds of stuff that happens. And yes, you have insurance for those types of things, but you also don't get those insurance reserves very fast. Those take time. Well, during that time, we didn't have enough DSCR, and we thought we're good. You know, we've known this lender for a long time. We know these people. They tripped it, and we had a $1.5 million cash call. Boom, that quickly, and it was life-changing for all of us. We found our way through it, but just something so catastrophic like that you don't personally control can have that effect.
Yeah. So going back to that, that's something else that you just triggered a memory for me that I didn't go over, that not only with your experience with all of these different asset classes and these big institutional players, but you've managed in just about every state in the union. So you have that experience that sometimes your lender is looking for somebody on your team that has experience in a particular area. And that's something else that you and Vacinia Living bring to the team, if you will, when you're looking, okay, who do I want on my team? Do I want this little local regional person that may only be handling A, B, and C, or do I want somebody with a national presence? And having said that, I know I'm now getting off track a little bit into your property management side, but on asset management, do you guys, I know you're building up Vacinia Living, which is primarily a property management company, but do you also offer as a standalone product asset management for somebody that maybe has owned a property for a couple of years and quite honestly, they're in over their head and they're in trouble and they're looking for a professional third-party property management?
Absolutely, we do, Jim. We love the industry, and we love to help wherever we can perform on the deals. And So we've done lots of asset management as well. That hasn't been my direct focus, but I always mention it that we can do it, and we can help at the beginning as well, and make it be, we can be like your training wheels, to really help you get your processes and pieces lined up on your first 2 or 3 deals. And then then you've got a good handle of how all the things are flowing, the kinds of questions to ask when you see certain things, and all of that. But absolutely, we can do third-party asset management.
So you had mentioned platforms and dashboards, and this is something that really piqued my interest. Can you talk to us about what technology, if any, that you use to measure KPIs? Or is this something that's still done longhand, so to speak?
I have my 10 key right here on my desk still, Jim. You'd be proud of me, and it's as old as you are. But no, I'm kidding. I do still have it here. Actually, with technology, I've always been, very forward with technology. There's all kinds of things out there for asset management, how to communicate with your investors, portals that they can log in, they can pull their own, they can see their own dashboards, how their each of their deals is performing. I mean, there's some good ones out there. I can tell you, Wilkinson, we went through 4. We did 4 full setups, and we did Juniper. We did a bunch of them until we finally found one that really worked and was user friendly enough for the investors to use, and was easy for the people to on the administrative side as well, but yet was robust enough to provide as much information we wanted, and a place for storage. But yeah, there's incredible tools out there. Do your homework before you launch. That's my advice. And it will give you lots of key measurements. There's so much data available today that you can't look at everything. So the dashboards that are created are there for you to be able to see trend shifts. So that way you, as an asset manager, can ask a few extra questions. Hey, I'm noticing, that the 2-bedroom traffic is down at the property. Do we think that's a problem coming up, in July when that's the last, big leasing month of the summer? So you can see all this, but it's hard to look at everything. So relying on dashboards is really the way to go these days, Jim, not the longhand.
So with that said, I know there's a handful of very popular back-end products for large property management companies that measure a lot of KPIs. And are you particularly fond of one over the other, is just specifically as it relates to KPIs that they're tracking? Do you see some of them doing a really good job and some, much better than others, or are they all pretty much on par?
So are we talking like on the property management side too?
Yeah. Mm-hmm.
Yeah. Okay. So I've had lots of experience in this, and had an opportunity to really look at multiple platforms over the years. And I chose to go with RealPage because I had the opportunity to spend a week at Yardi and a week at RealPage, and learning about each of their exhaustive platforms. And after coming through that, we chose to go with RealPage back in 2008. Yardi's come a long way since then. Hate their rent roll, would never go with them just because of their rent roll. but they've come a long ways, and technology has advanced forward, and they're growing and doing well. There's a lot of new little companies springing up everywhere: Appfolio, Resman, all of these others. They're running to catch up. Okay, there's some good pieces of those. It doesn't, those smaller groups or the smaller software platforms, you're not going to get as much as you get out of like a RealPage. but you're also not going to spend as much as what you spend at a RealPage either. You pay for what you get. Having spent so much time in the institutional world, data is king. If you don't have the data, you cannot even possibly forecast your way forward. And it's a guess. With more data, more focused relative data, you're going to be able to track your course better and rarely miss it. So that's why we prefer to use RealPage and their suite of products. It allows us full electronic interaction with our customer, with every part of the business we do is electronic, and it's done well by us, and we prefer that one.
So how granular, as an asset manager dealing with your property manager, how granular should we get in trying to keep our finger on the pulse of what's happening on the property? I mean, as it relates to something as little as walk-in traffic, or measuring, your advertising dollars spent in these 4 different metrics, phone calls, how many, how often, service calls, how long to answer, how many days. How granular do you think as an asset manager we should be getting on that?
Well, I'll answer it as a property manager. Just kidding. No, listen, you as an asset manager need to be as granular as you need to be. What's the data telling you? Okay. If operations if things are going along smooth, that's, or you're seeing pieces, I would pick out, 2 or 3 things each month to ask questions on. But you need to be aligned with the property manager. One, it's your partner. Okay, your property manager is not on the out. They're your partner in delivering performance. So one, you need to trust, but verify. Okay, so look at the numbers. Okay, what are you seeing? Is there anything for cause for alarm that you need to have a conversation with your property manager? Otherwise, too many calls, too many, like Jim, I've got some, I've had the experience of having some deals where there's 6, 8 people on a deal, and they're all coming to the calls, and they're all emailing. It takes time away from your property management team to answer all these calls, to answer all the emails that are cycling in. So, just know every call, if you have multiple people on your deal, if you don't come as one voice, then you're pulling your property manager away from operating your property. For every time that happens. So be sensitive to that. And just, keep an eye on what the numbers are. But more importantly, you, as an asset manager, you're responsible for approving projects. If you're approving projects, don't slow your property manager down by taking forever to make up, or it gets lost in your email, or not lost, it just cycles down to the bottom, or whatever. You're working on a new deal. Every day that goes by that you don't provide an answer to a decision to your property manager is 1 day less of performance driving behavior. You become a bottleneck and a cog in the wheel that we can't move forward as a property manager. If you don't turn that draw in, I think I mentioned this at the beginning of the call, you're 2 weeks late and you're thinking, oh, it's just two weeks after. I got this like early last week. That's fine. No, it was already 30 days for the vendor when they submitted their invoice, because we do everything 30-day net. So now by the time you submit it and the lender does it, the vendor's not getting paid for 75 days. They walk off the job for that. But I like to remind people, no decision becomes your decision. And that happens too frequently with asset managers, Jim. It's one of my biggest pain points is they don't know how to make a decision, or there's too many different votes in making the decision. or they're just they don't know what the guidance is for the decision. They haven't been given clear business. Their business plan isn't clear enough, or there's some changing factor in the market. Work with your property manager to better understand what's happening, because you're holding up progress in the performance of the property by not making a decision. Sometimes you're just scared to, because it's like, it's a big decision. And it's like, okay, both decisions don't look like the best one. And you only have two to choose from. Sometimes you have to make the best decision that you have to keep progress moving, okay? Yeah, and no decision becomes your decision.
So I was going to end on asking you maybe some of the KPIs, the biggest ones that we miss or mess up on, but I think you might have just landed on one, which is measuring the decision-making time frame from the asset manager to the property manager, and being able to actually make a decision. And I think that's especially in our world, and you hear me call us affectionately mom and pop syndicators, because we're not institutional players, and we're all building this as a team. And sometimes our teams can get a little large and unruly. And I think it's very important for us to realize that. And when we're dealing with other professionals in the industry like yourself, that we have to, amongst our GP team, pick a leader, pick a spokesperson, and they may or may not be the same person, but you can only come at your other professional partners with one voice. And the rest of you, if you're on the call, need to keep your mouth shut and let your spokesperson speak, or else you're just going to create chaos. And I'm very sensitive to that also. I've been in those situations where, you know, I'm just as frustrated sometimes sitting in the background trying to keep my mouth shut. But there's a time and a place for you to have those discussions, and it's not during that meeting.
Mm-hmm.
So,
and as a property management group, that's what we do. We come as a team to a call. We have one main spokesperson, and even though someone might direct a call to someone else, that spokesperson takes the question back, because everybody's in communication on Skype and everything else, and Teams, and everything's funneling through. So it's a voice. We stand united as a voice. And Jim, just real quick, I want to make sure that if I said mom and pop and use that term in a derogatory way, I couldn't have possibly meant it that way, because I was a mom and pop.
I am a mom and pop.
That's all there was. I am a mom and pop.
So am I. I'm proud of it.
No, yeah. I mean, I grew up before there was all these huge companies, you know, when in the 70s, you know, late 70s, that, you know, big companies like this didn't exist. A few big ones, but nothing like what we see today. Anyway, so.
No, we're very lucky to be living through the time that we are right now, that us mom and pop syndicators have all of this technology at our fingertips, have the ability to work with professionals like you. We're living in a very fortunate time. But I'll close with the question, which I just briefly mentioned. What do you see as some of the key performance indicators that we're missing, that we should be tracking, or maybe we are, but we're not doing it effectively?
Well, I mean, none of the models that come over to me have DSCR in them. Okay, none. Is that what you mean? Is that what you're asking me?
Yeah, or I would even go so far as to say, even getting, we were talking about getting granular. A big one for me, I really, and I know it's a property management KPI, but as an asset manager, I believe you have to be tracking every KPI that the property manager is tracking. Not that you have to be responsible for the inputs, but you need to know what the numbers are. And you need to be looking at them. And I really always come down very firmly. The number one thing that you can do as a property manager and as an asset manager is to stay on top of maintenance request. how long it takes to answer them, and how long it takes to fix them. That's the biggest thing that affects turnover. And turnover is one of the things that affects cash flow the most. So that would be an example for me of one of the ones that I think I just need to be on top of that one.
I see what you mean. I have two that encompass it all. Heads on beds, which means lease them, drive your traffic, lease them, turn the units, all that. Heads on beds, collect the dough. If you do those two basic things, they touch everything in property management. That includes maintenance, surveys, all of that. There's so many different things you can do, but heads on beds, collect the dough, and you're ahead of the game.
Okay. Well, with that, Mark, was there anything that you wanted to add or ask Kimra, or how do you want to proceed from here?
Well, I'm actually just monitoring the chats. I know we had 2 questions that came in. One from Ken. I'm not sure if he's still on. Feel free to ask your question.
Yeah, Kimra, when taking over a property, you mentioned about the differences between like the bank statement stuff. How valuable, or is it worth getting a estoppel documents from the tenants to say, hey, this isn't the lease, this is what I've paid, this is the security deposit? Is that something we can use to help mitigate that risk of it, when we turn over, like stuff falling through the cracks, or is that just, not really that valuable?
I'm sorry, Kenneth, you asking the residents for what? I missed that.
It's like, I think it's called the estoppel documents. Just
the eviction documents. Mm-hmm.
So I'll expand on that a little bit, Kim.
Okay.
So typically in larger apartment complexes, we ask for a certified rent roll if we don't trust the stuff that we're getting. And another way of doing that, and you don't see it so much in larger assets as you do in small ones, where the attorney will draft an estoppel letter, which basically the tenant has to sign and certify where they are, when my rent expires, how much I owe, how much I pay per month, those types of things. They self-certify that instead of the owner certifying it.
Oh.
So typically you would want one or the other, of those things. You would ask for them in PSA. But I don't think that, honestly, very many people actually ask for them or get them. But Kimra, I can let you speak to that as far as getting a certified rent roll or an estoppel letter.
Every rent roll that ever went out from us as a property manager for a closing was always asked to be certified. Now, as a property manager inside a vertically integrated company, that's one thing, but you as the owner typically ought to be requested to sign or certify the rent roll. There is nothing wrong with writing a certified rent roll on your PSA, and I would do that all day long. Mm-hmm.
Well, but what if it's like a literal mom and pop shop, a small like 12 to 24 unit?
I love this.
And they don't have like a PM, they just have like ledgers and stuff like that, just to cover your, as a buyer, covering your.
Yeah.
I
think that's a great idea. I apologize, Kenneth. While I do have some smaller properties that we do manage, I didn't. They came with a portfolio, but it's been many years. Most of the properties I've done are bigger than that. But I think that's a great idea, and I'm going to use it. I think it's a great idea. Now, it's not realistic that they can, wrangle up that on 200 units probably in a short amount of time, but that's a great idea. And I picked up something new. Love it. I love life every day. Keep seeing
Greg, I know that you've got your hand raised. Do you want to ask your question?
So just hold off for 1 minute, Greg. Robert Aragona had asked a question to Kimra. He was asking, should he be using all of the 8 KPIs that you mentioned on smaller properties, like 20 doors and below?
Absolutely. These are deals. If you underwrote your deal to buy it, then you should be using these KPIs. You should know what the market's doing. You should know where your NOI is, your revenue. I would be doing it on every asset I owned, no matter the size. Mhm.
Good, thanks.
You're welcome.
Go ahead, Greg. Shoot your shot, my friend.
Thank you, Mark. Kimra, thank you so much for the information you provided. I have a actually, I had two questions, but I'll start with one and then come back later. Question one. So during the underwriting and due diligence, is it wise to also ask for tax information for things that they have actually reported in taxes? That way you can actually see what the data is.
Absolutely. Yeah, we always request all the real estate tax records for 3 years.
Oh, 3 years. Okay, great to know.
That's what we do. If it exists, they may not have owned it for that long, but. Mhm.
If there's no one else, I can ask one more question.
Well, you might as well ask all your questions now, and then we have James.
Okay. Thank you. So the last question. Since I guess some owners of multifamily tend to load a bunch of things, and also will find and put tenants in within a year of selling. How much more weight do you put on tenants who have been there longer compared to the newer tenants? Given that they may have just loaded some tenants in there just to fill the vacancy levels and make it seem like it's fully vacant, fully occupied.
So that's where reviewing their screening criteria and the results come in handy to best understand, did they do it the right way or did they pull some shenanigans? I can tell you, just because you see a fast lease up doesn't mean it's not possible. We picked up a small portfolio, and the last 2 weeks of March, we took 53 applications in 2 weeks' time, 48 approvals. Okay, and that's real. And that's just a small little group. Okay, it can happen with the right traffic. So it's one of those things you can trust, but verify. You know, double check, look at the screening. Did they fill it with residents who aren't going to pay? But as far as being able to say longer term residents are your better residents than others, with COVID and the pandemic, that kind of shifted some things for folks. You know, a lot of people lost jobs. Their careers were upended. It's not just a black and white thing. You don't know if that's the case or not. It is a gray area. So. Hope that answers.
So I had a question that was asked of me directly, Kimra, but I'll let you answer it, which was, excuse me, I went right past it there again. Does the lender inform us or when and how the DSCR will be assessed or measured? And can it be changed from what may or may not be in the original loan doc?
Yeah, what you got when you close that loan is what you got, and that's what you're going to be held to. So, it depends. I don't really know exactly how that gets determined. I think I saw Julie Peterson on, with the long-haired Jim Biggs in the background. Julie, do you know the answer to that? Our favorite old capital lender, babe?
Shame on her.
Yeah.
Who is that long-haired hippie guy in the background?
That's why I laughed a while ago. I saw it all of a sudden.
Oh my God, look at that.
It is hilarious. But do you know the answer to that, Julie?
Okay, the question was,
when the DSCR is determined, when does that, it happens in the loan docs. Can that be negotiated with the lender, or it's kind of just, that's the
no, it's based on the market.
So I think more specifically, Julie, was can they change the timing? In other words, is it in the loan documents how often what their metric is for measuring, whether they're
Like
measuring
quarterly.
monthly, quarterly, biannually. Is that typically in your loan document? And if not,
Typically it is, and it's usually quarterly.
and can they
What
change that on you?
I would think they could change it, but they'd give you notification.
Okay.
And I would tell you that a lot of asset managers will send it monthly, just so that it keeps the lender, your biggest partner, up to date on all of the financials.
Yeah.
You don't want people to be making assumptions on your behalf. If you can provide them with paperwork, that gives them no reason to doubt what you're doing or to have concerns.
Yeah, and that's why measuring the DSCR in the models, Jim, is so important, because if you might drop below a 1, and if you're dropping below 1, I guarantee you're tripping a trigger if it goes for a quarter.
So Kimra, did you have your 8 KPIs handy?
I do.
Could you name them off again? We had a couple of different people ask what they were.
Oh, sure. 1, cap rates. 2, IRR. 3, EGI, total income revenue. 4, NOI, revenue minus expenses. Cash on cash return. Number 6, DSCR. Number 7, cash flow management. And number 8, investment performance analytics measurements.
Thank you. Mark, are you tracking anyone else, or is James up next?
James is up next. I don't have anyone else on my end.
Thank you, folks. Thanks, Kimra, for this information. It's very helpful. I apologize if you said it and I missed it earlier, but you had given an example in the beginning about that owner that was infusing money, his own cash, into the spreadsheet. Was there a trigger or a sign that raised that red flag that made you say, hey, something's wrong here? Something in the T12 that raised an eyebrow?
Well, the revenue looked too high for the type of property it was. The percent collected just seemed, what he was showing his total revenue to be just seemed high on a property that is seriously distressed in a tough market.
Okay.
Coming out, right in the middle, kind of right at the end of the in May and June. Okay, so we knew it was definitely impacted by COVID. Everybody, all the cars in the parking lot,
Yeah. So it was last year.
Everybody's home, they're not working.
Yeah. So it was last year in the middle of COVID in a distressed area.
Right. Yes.
Got it.
Yes. So we asked to validate, trust, but verify. But yeah.
Thank you.
You're welcome.
I have a question from Rick, who's inquiring, what is cash flow management?
Cash flow is knowing how much money you got coming in each month. I mean, it really is as simple as that, Rick. It's not just what your NOI says, because after NOI comes your debt service. Do you have interest? Or goodness sakes, how many of you are getting loans with interest only for 2 years? Know that your interest only time period is running out, because that's going to hit your cash flow next month if it runs out next month. And so that's probably the biggest, most profound shift in your cash flow to lose sight of, that can really impact you. But there's, your capital expenditures. If you have a major boiler or a major, a major plumbing leak on the property that costs you $30,000, that's going to impact the cash that's coming in off the property that month. So that's what I mean by cash flow management.
So if we don't have any other pressing questions, because I know we went a little over, Mark, I apologize, but I think this was just phenomenal information for people to get. Do you want to have some breakout calls or breakout rooms?
Yeah, sure. I mean, I scheduled this thing for 2 hours, so we're here to network and talk.
Well, and feel free if you guys, I know for some people it can get late and 2 hours is a long time, but if you want to have breakout rooms, or if you don't want to have breakout rooms, now would be the time to jump off. But if you do have any other last minute questions, make sure you ask them within the next 60 seconds.
Thank you, everyone.
The one thing we did leave off is, Kimra, could you drop in the chat before we go into breakout rooms, how people can connect with you, or also connect with Vacinia Property Management, or get in touch with you for asset management?
I will. Thank you.
Thank you.
Welcome back, everyone. Should we go for one more? What say you?
I gotta jump, Mark, but it was not great seeing everyone.
Ah, thanks, Ken.
Thank you.
Thanks, Rick. Well, since the numbers are dropping, I guess we might as well just after party on here as a big group.
Gotta love the after party.
Yeah, I love those.
Great job, Mark. Great job orchestrating and putting everything together. And, you know, really you've done it. It was a very informative, great content. So nice meetup. Nice job.
Thank you. I could not have done all of this without Jim's help. Jim was the big component. And Kimra, thank you so much for actually jumping on. You know, I've learned a lot, and I appreciate you sharing all your knowledge.
Sure. Well, thank you for having me.
Great job, Kimra.
Thanks, Bruce.
And Jim, hey, you did pretty good too.
Hey, when you've got a good guest, all you got to do is ask a couple of questions and let them loose, right?
I tell you what, talk about lobbing a softball up there.
That's right.
She's a stud, I'll tell you.
Thanks for the insight, Kimra and Jim. Really appreciate it.
Absolutely.
Good to see you again, Matt.
Absolutely. Thank you. Thank you. Thank you.